Hi everyone, welcome to this evening's session. We'll start at 6:02, so 2 more minutes. If you need to go to the washroom or you have a last minute, your friend is still trying to reach you on time, just do text them. We'll be starting in a quick moment. Thank you. All right, welcome everyone. So my name is Jason. I'm part of the advisory team here at Syfe. For those of you who have joined us either physically here or online, welcome to tonight's session on Market Outlook 2024. So if you see on the screen behind me, you will see a QR code. This will actually be the main form of interaction with us here this evening. So if you just scan it, like what I'm doing right now, right? You will see two sections, the poll questions and the Q&A section. Right, so for the poll question, we do ask for you to actually fill it up. It's a quick 3-question poll, right? And for the Q&A, of course, if you have any questions that you would like to raise up for the panelists and the speakers, you can actually input it over there as well. Of course, you can go in and you can also see other questions that are posed by the audience members, right? And then you can actually vote, saying that you would also like to ask that question. Right, for those of us who are physically here with us, the panelists are also available after the session, right? So you may also approach them. All right, without further ado, let me just introduce the speakers here this evening. Each of them represent very different asset classes and sectors. All right, first of all, we have Giri from BlackRock, the world's largest asset manager. So for those of you who joined us last year at our 2023 Outlook session, you'll find him a very familiar face. He's an investment strategist with BlackRock iShares business in APAC. He has more than a decade's experience spanning macroeconomics, finance, and international relations. Next, we have Alice from PIMCO. PIMCO is the global leader in fixed income assets. Alice is the senior vice president in the Singapore office and head of the Singapore retail business. Alice brings more than 15 years of investment and financial services experience to the table. Next, we have Brendan from KraneShares. Brendan is the chief investment officer, and he leads the firm's research and education efforts. His career has spanned a period of enormous growth for ETFs, and he has a profound knowledge of the ETF landscape. He's going to focus especially on China this evening. And last but certainly not least, we have Ritesh representing Syfe. Ritesh is VP, Head of Investment and Advisory. He's responsible for the overall development and evolution of Syfe's investment product suite. So Ritesh also has more than 15 years of experience as well. Right, so before I hand the time over to the speakers, for the benefit of those who are joining us here for the first time this evening, I will give a quick 3-minute introduction to Syfe. So Syfe is a digital investment platform. We seek to empower our clients to build their wealth for a better future. We are headquartered here in Singapore, right, and we are licensed by MAS as well. We practice a mobile-first approach where our managed portfolios, our cash management solutions, and our brokerage platform is all accessible within the same single app. So this actually allows our clients to invest in a very holistic and seamless manner. We are trusted by over 100,000 users here in Singapore, right? And this is a quick snapshot of our journey to date. So we launched in Singapore July 2019, right? And we have gone through several significant milestones within a very short span of time. So in 2023, we've actually introduced our Income Plus portfolio powered by PIMCO, right? And we've actually further augmented our cash management solutions as well. Right, I'll pass the time over to Ritesh, who will actually give us a quick 2023 market review. Ritesh, please.
Wow, incredible. Thanks everyone for braving the rain and coming in here. Once again, welcome to Syfe's 2024 Market Outlook event. I'm very excited to see an almost full house and even more excited to see what 2024 holds in front of us. I hope in today's session, you get equipped with the right tools to make the right investment decisions for 2024 and beyond. To kickstart today's event, let me do a quick review of how 2023 fared in the global markets. So 2023 proved to be a year that defied everyone's expectations. We saw a surprisingly robust US economy, even in terms of soaring bond yields. We saw the US stock market reaching near all-time highs, and we also saw disinflation firmly taking hold, leading to a sharp drop in treasury yields by the end of the year, with the Fed finally pivoting. On the equities side, so on the equities side, the S&P 500 bounced by more than 24% in 2023, while the tech-heavy NASDAQ index moved by 43%, one of its strongest performances in over 2 decades. However, the bulk of the stock market gains was dominated by a few tech-heavy stocks, which resulted in over 70% of the market gains coming from these Magnificent Seven companies. While most asset classes turned positive in 2023 in terms of overall returns, it was notable that cash actually underperformed many other asset classes. So if you look at this, most of the asset classes turned up with double-digit returns, but cash was close to 5% of annual returns. That just kind of tells us that a lot of investors who held on to excess cash for the year missed out on the opportunity to capitalize on the market rally because they were very cautious and remained underweight in risky assets, and thereby kind of missing out on this rally that happened through last year. In terms of rates, the Fed finally halted its rate hiking spree and signaled rate cuts in 2024, as more consistent disinflationary trends finally emerged. This led to a whipsaw effect on the interest rates, with the US Treasury moving from 3.5% at the start of the year to 5% in October, and then moving back down to 3.9% with the final dovish pivot from the Fed. Looking ahead, while the global growth is expected to slow down in 2024, the possibility of a deep recession looks unlikely as inflation continues to moderate and the Fed looks set to do a few rate cuts in the second half of this year. With that backdrop, I would like to hand over to our esteemed speakers from BlackRock, PIMCO, and KraneShares to go over the 2024 macro outlook for everyone. Thank you, everyone, and look forward to speaking with all of you during the networking session later on as well. Thank you.
All right, I think Ritesh has done it, but let's welcome Giri from BlackRock again.
Thanks very much, and good evening, everyone. It's very nice to be back with you here at Syfe for the Market Outlook this year. I'm supposed to talk about global equities, and global equities is a big place. So I'm going to cheat a little bit and talk mainly about the United States. I will talk a little bit about emerging markets, and at the end, I will talk a bit about Japan because I think what's going on in Japan is very interesting. But most of this is going to be a tour about the United States, not all of its investment recommendations. It's mainly to give you color into some of the subsectors, some of the themes, some of the trends that we're seeing in a bit of a higher resolution picture as to what's going on. So let me start with some macro thoughts. This is the chart showing the very, very impressive job growth that the United States has seen over the past year, the monthly changes in black, and the cumulative change in payrolls in orange. And as you can see, that's a very impressive number, but if we zoom out and look at a longer time horizon, we actually can see there's this gap, right, between the orange line and the yellow line there, and that represents all of the workers who have actually left the US labor force. These are people like retirees, who took their pensions and decided to retire, and therefore you have a structural deficit of labor in the US at the moment, and that looks like it's going to continue. And I think this is one of the reasons that explains the economic resilience that we have seen over the last year to 18 months in the United States. And the reason is that when you have insufficient workers, well, people don't lose their jobs. And it also means that the workers who have jobs can go for pay rises, they can change jobs and get higher pay at the same time. So that produces a degree of resilience in the US labor market. And people who have jobs, of course, consume and continue to pay their mortgages. And as we know, about 70% of the US economy is consumption, which therefore continues relatively unabated. Similarly, with low mortgage delinquency rates, because everyone's paying their mortgages, you don't have a 2008 style mass foreclosures, forced sales in the property market, and that has meant that property prices have remained surprisingly resilient despite a record pace of interest rate rise, certainly one of the fastest paces in the last 40 years. So that brings me to my first sort of sub-sectoral observation that actually it's been a very good environment for home constructors and home builders in the United States. So if you think about the US mortgage market, you get a mortgage for 30 years. Pre-pandemic, you would have been paying 3 to 4% fixed rate for 30 years, and that means that you really have no incentive to sell your house during the pandemic or in the post-pandemic environment and then have to buy a new house and pay 7%, 6-7% for your mortgages. And so that meant that the housing supply really collapsed from people who were selling on their homes, and it meant that all the new supply in the US housing market was coming from home builders who massively increased their market share, and that has meant that after selling off very precipitously in 2022, we saw a big rally in home builders last year, and with house prices set to turn and move higher this year, greater consumer confidence, it's quite likely that we will see that trend continuing. So that's the first subsector observation on the US home builders and home construction market. Let's look at the picture on inflation. I'll direct you to the left-hand chart. You can see that inflation is coming down, both wage inflation and core inflation, but it still remains around double the official 2% target. So the big question for this year from a macroeconomic perspective is whether or not inflation will come down before rate hikes slow the economy and cause a recession. The official BlackRock view is that we think that the Fed will eventually cause an economic slowdown. And because of that, our recommendation is for investors to remain underweight the US market, but within that, to overweight specific megatrends, what we call mega forces. These are structural, long-term forces that we think will help to counterbalance any cyclical slowdown we see in the month and the year ahead, right? And to make this case, for specificity in investing, I'd like to turn your attention to the right-hand side graph there, which shows that the dispersion of equity earnings in recent times, and it shows that on average, dispersion within the equity market is much higher, which means that those who do well do very much better than the companies who do badly. And so if you took a broad index approach to investing, then you invested both in those who are doing well as those who are doing very, very badly, and therefore you kind of sort of cancel out. And so there is an argument for a bit more specificity, a little bit more selectivity, and our argument is that investors should concentrate in parts of the economy where there are structural megatrends, and that should provide a degree of earnings visibility, a degree of earnings confidence as we head into the year ahead. So what are these broad trends? Well, some of you will be familiar with this because I talked about some of these trends last year. I'm going to focus mainly on the ones in yellow, so digital disruption, geopolitics, and reshoring, reshoring as well as the low carbon transition, but we do also like things like investing in aging population, things like healthcare. We also like future of finance, in fintech, things like that. But I'm not going to focus on those in my remarks today. I'm going to focus on the first three, starting with AI. So, as we all know, AI has been a major driver of the equity market rally over the past year. You can see that on the left-hand graph. I think the right-hand chart gives you a bit of a graphical breakdown as where we see the investment opportunity set in AI going forward. So all of us know, starting from the bottom to the top, the whole diagram is what you might call a tech stack, which is a group of software and hardware components which work together to deliver a specific effect. And generative AI does have its own tech stack. At the base of which, you've got semiconductors, which are doing the computational heavy lifting. You have the cloud infrastructure from the cloud hyperscalers, Google, Amazon, and Microsoft. And then in the middle layer, you have the new stuff, the foundational models that are being developed, but also the data that's being used to train those models, and the data infrastructure that allows that sort of large-scale computational effect to interface with the underlying hardware. And finally, you have the top layer, which is the apps and software, which actually generate the ultimate insights. That's what we interface with when we use something like ChatGPT, right? And so I think this is a useful framework to think about the evolution of the opportunity set within AI. At the moment, the outperformers have been those at the bottom, but as we proceed through this generational change, the opportunity set, we think, will migrate further up that diagram, eventually ending up in the application space. And at BlackRock, we think that the companies that have the proprietary data sets that will allow the algorithms to be trained will be the next phase in the development and evolution of the AI opportunity. I'm sure this will come up in Q&A, so I shall leave it at that and make some more progress on some of the other areas. In particular, let me talk about geopolitics and the low carbon transition. Here, I almost want to take them together. So when we talk about geopolitics, there are a few things that I mentioned last year, and I'll repeat them today very briefly because they remain relevant trends. And so the first is that with rising geopolitical fragmentation, that presents an opportunity for emerging markets, particularly countries like Mexico, Vietnam, and India. We have already seen how Mexico has overtaken China and Canada to become the United States' #1 trading partner in the past year. And as of November, according to the Wall Street Journal, China now does more trade with developing countries than with the United States, Europe, and Japan combined. So geopolitical fragmentation and reshoring is a very real phenomenon, and we think that it has legs to run for the rest of this decade. The other opportunities, and I'll take them together, are in things like robotics, in cybersecurity, and of course, aerospace and defense. With robotics, we have seen potentially a record number of jobs now being reshored to the United States, at the same time as we have seen there is a structural undersupply of labor. This creates an opportunity for robotics, and particularly new business models within robotics, such as things like robotics as a service, where you have robotics providers who outsource the robots, and they are paid on a service basis. And so these new business models may reduce the cost of robotics provision, and we see that as another structural megatrend that's likely to benefit investors going forward. Cybersecurity and aerospace and defense, I think, are self-explanatory in this new environment. I would note that cyber attacks between 2019 and 2022 were up something like 80%, and it's probably higher since then. And bear in mind that as we move to a world where AI is increasingly used, as cloud computing is increasingly used, and as computational power migrates closer to population centers in what is called edge computing, then cybersecurity itself is going to become more important and evolve as that tech ecosystem evolves. And so there's a very live opportunity set that remains in place in the cybersecurity domain. Aerospace and defense, I talked about this last year. It remains, obviously, with all of the turmoil in the Middle East, a relevant phenomenon. It could be getting a bit long in the tooth, and a lot of it depends on US defense funding, but what I want to point out today is it's not just the defense component of aerospace and defense that has a structural uplift to it. We are in the midst of secular growth in air travel as the global middle class grows. And you saw that, no better evidence of that in the Dubai Air Show a few months ago. You saw massive orders coming from the Middle Eastern carriers, from Saudi Arabia, from Turkey, from the UAE, as well as Egypt. And so this secular demand for air travel, all that pent-up demand from the pandemic is really turbocharging it. It runs at a couple of % above global GDP growth rates, and we think that's going to continue in a context where there's a structural undersupply of aircraft. We've seen all the problems that Boeing has had, that Spirit AeroSystems have had, that Raytheon have had. And so I think that going forward, as these companies resolve these supply issues, all that pent-up demand is going to come through the pipe and create a bull case for the aerospace sector. Lastly, before I move on to Japan, let me talk a little bit about the low-carbon transition and talk about an unusual way of playing this theme, which is industrials. Now, industrials as a segment didn't do great last year, and 20% of industrials is actually aerospace and defense, so it's actually a diversified way of playing the geopolitics theme. But I think this year we will see increasing evidence of substantial industrial order flow for equipment from industrial manufacturers, and that's because of these massive projects associated with the low-carbon transition, but also with the semiconductor reshoring trend in the United States. You think about the industrial systems that are required, the cooling systems, the that are required in battery plants for clean energy, for semiconductor plants. That requires an immense amount of industrial equipment to populate all of that infrastructure that's been built out. And we've had a large number of projects that have been announced in the past few years. Many of these projects will be coming online in 2025, 2026, and therefore we will have an increasing amount of demand for industrial products after a year where order flow for industrials hasn't been great. Finally, let me move on to Japan. I only have 3 minutes, so I shall rifle through this. As we know, Japan has experienced a very extended period of low growth and low inflation. And that is because when the real estate bubble in Japan burst in the 1980s, people had taken up debt to borrow to purchase assets in extremely high valuation levels, and then those asset prices collapsed. And that meant for much of the 1990s and 2000s, Japanese corporates and Japanese households were really focused on paying down debt levels. And that meant that households weren't consuming, and it also meant that with household consumption low, Japanese businesses were not investing in Japan. And consumption and investment are the two biggest drivers of GDP, which explains why GDP was so anemic for so long. And if you consider how efficient the Japanese are at producing, that meant that the supply that they were able to produce was so large that demand was unable to keep up, and that kept inflation low. Now, the Bank of Japan and the Tokyo Stock Exchange are trying to change the fundamental psychology that this long-term phenomenon has produced. And that psychology is as follows. If money is going to be less worth more tomorrow today, if you have prices that are declining every year, money tomorrow is worth more than money today. And therefore it makes sense for you to save even in low-yielding investments, because you know in real terms you can buy more tomorrow. So that's the household picture. In the corporate side of things, corporates became highly risk-averse. They didn't invest in taking risk and reinvesting profits. They kept profits sitting on corporate balance sheets. And so what the Tokyo Stock Exchange, through its buyback incentive program, and what the BOJ is trying to do by generating inflation, is they're trying to reduce the proportion of cash that is sitting on corporate balance sheets and send that to household balance sheets. And there are a number of ways in which they are trying to do this. Firstly, by increasing inflation, they increase the bargaining power of labor in the annual wage-setting negotiations. And this means that this is one way corporate profits can be moved onto household balance sheets. Secondly, if households believe that inflation will be permanently higher, this reduces the incentive to save and increases the incentive to consume today. It's the reversal of the trend I talked about earlier. Thirdly, through higher dividends and share buybacks, this boosts the asset side of household balance sheets relative to corporate balance sheets. Fourthly, by generating inflation, corporates can focus on growing revenue rather than spending the last 30 years on cutting costs because prices can't go up. Finally, all of this creates incentives to invest in the Japanese equity market and on driving earnings growth for corporates in that country. I'm running short of time, so I shall be very brief in the final few slides and simply point out that look at the chart on Japan and the proportion of household assets that are held in currency and deposits. That's about 8 trillion US dollars, much higher than the United States and the Euro area. There is now tax incentives that have been issued by the Japanese government for Japanese savers to invest in the equity markets. And therefore, as of this January, we expect flows from Japanese savers to move into higher risk spectrums of the market, including the Japanese equity market, and all of that contributes to a bull case for Japanese equities. I think I'll leave it there. Apologies for running slightly over, and let me hand it over. Thank you very much.
Thank you very much, Giri. Up next, we have Alice from PIMCO, who will go through with us the global fixed income assets. Alice, please.
Hi, good evening, everyone. Thank you for making time to attend today's event. Can you hear me? Right, okay. So the previous speaker, Giri, talked a lot about the equity outlook. So today I'm here to talk about a different asset class on fixed income. And of course, interestingly, I find it quite interesting that typically the equity managers are always the optimists and the fixed income investors are always the more cautious and more pessimistic. But I find it very interesting that Giri talked about how they expect that there's going to be a bit more of a potential slowdown in the US, which is actually quite consistent with our view where we think that there is actually potential for still elevated recessionary risks in US and some of the other developed market economies as well. So I think that bodes well for fixed income investing because if you do expect to see that there is potential for some downside in growth, potential for economic slowdown, you do want to have a bit more of these higher quality assets like bonds to provide a bit more diversification against equities and to provide more downside protection in your portfolios. So why do we think that there's going to be a elevated risk of a slowdown? We do think that there is potential that we are able to avoid the recession. So a soft landing, which is actually what a lot of investors are now expecting, it is certainly likely, but we still see elevated risks of a recession. Just now, the previous speaker, Giri, talked about the standout resilience of the US back in 2023 last year. And he pointed out the fact that there is the strong labor market. Now, we agree with that. And on top of that, one of the reasons why the US economy was actually quite resilient last year was because that there was a lot of excess savings that were being built up over the past couple of years from COVID pandemic. So recall back in the years of COVID, a lot of the developed market, a lot of governments globally actually provided a lot of relief, tax subsidies, savings, support to the consumers, to the businesses. So, but at the same time, a lot of households, a lot of consumers did not spend that money. So as a result, savings build up over time, which means that once we are starting to get back to normal, a lot of people have a lot of savings to spend. So demand was there, and that actually helped to underpin the resilience of the economy last year. Having said that, we all also know that inflation has been very high. It is coming down, but it is relatively still quite elevated, and inflation erodes into your real purchasing power. It erodes into your power of savings. So over time, right now, if you look at the current core CPI in the US, which Giri also mentioned, core CPI, whilst it has moderated, it is still running at around 4%. So it is still quite high, and over time, we think that as the savings gets eroded, that could mean that there is elevated risk of slowdown. So we are not out of the woods yet. in other terms. So again, investors need to consider having to build a bit more downside protection in the portfolios and having that allocation to bonds. Another reason why we think that investors should have bonds in the portfolio right now is because there is actually more upside. Potentially, there's capital gains to be reaped in the bond markets. In the past 2 years, in 2022, 2023, we were in a rate hiking cycle. So central banks like the US Fed, other central banks like the ECB, Bank of England, etc., they were all raising interest rates. And obviously, that was a bad time for, that was a difficult time as bond investors, because as yields go up, bond prices go down. They move in opposite directions. Now, the Fed has clearly communicated to the market now that they are done with hiking rates, because they are seeing that inflation is starting to come down, so they have actually started to achieve what they are setting out to do, which is to contain inflation. And at the same time, we do see that there are signs that the economy is slowing down. So the labor market still remains strong, but we have actually seen some high-frequency data that shows that unemployment numbers are starting to slowly tick up. So we do think that the Fed is unlikely to further hike rates at this point. Now the question more is, when will they cut? And by how much will they cut? So right now, in terms of the pain for fixed income, is pretty much behind us. Because when the Fed starts to cut rates, then bond prices actually reverse course and bond prices go up, which means that there's capital appreciation potential for bond investors. So again, how much potential is there? So we look at historically, when we look at how much has the Fed, right? Because everyone looks at the US as a guide. So when you look at historical past cycles where the Fed has started to cut rates, how much do they cut? So, and it depends on whether the economy is in a recession or not, because if the economy is not in a recession, the Fed and the other central banks, they don't need to do so much. They don't need to cut as much. If the economy is in a recession, then they need to cut more to provide more support to stimulate the economy. Now over here, I have, you can see two colors on the right-hand side. There are two dotted lines. The cyan, or rather the blue dotted line, that shows you how much the Fed has historically cut rates if the economy is not in a recession, and typically that's around 2%. Okay, so if there's no recession, typically the Fed will cut rates by 2% in a rate cut cycle. If you do see a recession, which I just mentioned that we still see that there is risk that the economy will head into a slower growth environment. Typically in a recession, the Fed will cut rates by 5%. So that's the red dotted line. Now there is also a green line you can see over there. The green line is what is being priced into the markets at this point in time. So how much are investors expecting right now? And you can see that that's actually in line with the no recession scenario. So that means right now, based on what has already been reflected in the market pricing, investors are expecting there's going to be no recession at all. Okay, no chance of a slowdown. So, but the thing is that means that if we are right and the economy does slow down a bit more than expected, that's when there's more room for interest rates to fall further from this point. In which case, that means that bond prices have more potential to go up. So again, I think this paints a very clear picture that we think that there is further upside in the bond markets at this point in time, even despite the recent rally that we've seen in the bond markets, especially in the months of November and December 2023. So moving on in terms of what this means for investors, we think that bonds right now have a very compelling place in your portfolio for a couple of reasons, two of which I've kind of mentioned earlier, which is number one, to provide that downside protection, diversification against equities if you do see a slowdown, continued slowdown in growth, and higher upside potential. And at the same time, we think that because of the interest rate environment that we're in currently, where we are at peak rates, the Fed has hiked rates very aggressively from zero at the start of 2022. Now the US Fed funds rate is at 5.5. So right now interest rates are at pretty attractive levels that we've not seen for many years. So the higher yields actually means higher expected returns, and I'll talk a bit more of that shortly. Now we think that because of the current high interest rate environment, which I just mentioned earlier, higher yields means expected higher returns. We think that right now, bonds can provide potential to offer equity-like returns, but with much lower volatility. Now that's actually quite unusual, because typically higher risk means higher returns, and typically we are expecting to have higher returns by investing in the stock markets rather than the bond markets. Bond markets typically are expected to be stable but boring. But starting valuations, starting price is very important. At which point you enter the market, right? Because we all know that you need to buy low and sell high. Right now, if you look at the S&P 500, for example, it is actually at pretty much all-time highs. The cyclically adjusted PE ratio for the S&P 500 is actually above 30. Okay, so that's very high. And in contrast, bond markets actually look very attractive right now, because I just mentioned that we have not seen yields at current levels since the global financial crisis in 2008. So yields right now are the highest that we've seen in 15 years. And the higher the yields are, that means the lower the bond prices. So whilst equities are looking expensive, bonds are looking cheap. And again, going back to look at historical evidence, when we overlay current conditions, so when we look at historically, if equities had a price to earnings ratio of 30 and above, the returns are shown in the blue line for equities. And when bonds have a yield of 5% or above, the expected forward-looking returns are in the green line. So there are two things to notice here. One is you can see that actually bonds have a higher expected return than equities. That's one thing. And also you can see that the shape of the line as well. The shape of the line, the green line, which is for bonds, is a lot narrower, which means that there's higher certainty in terms of how much your return you're getting in the bond markets. Of course, in the blue line, you can see that there is actually quite a big tail. That means there is still quite a good chance that in equity markets, you can still make good returns, but there is less certainty there. And so we think that right now, bonds offer a very unique opportunity, given this current environment, to give you potentially equity-like returns, again, but with much lower volatility, much more certainty in your investment outcomes. But of course, again, I want to stress that it doesn't mean that all bonds are equal. We also need to be very discerning in terms of what type of bonds can give you that kind of returns. So again, valuations matter, the asset prices matter. So you can see that across the different parts of the bond markets, there is differentiation. So on the right-hand side, you will see a lot of lines. So left-hand side of this of these lines, we compare the current valuations of the different bond sectors versus its 10-year long-term history. And on the left-hand side, it's expensive. Right-hand side, it is cheap. So right now, despite the recent rally that we've seen in the bond markets in the last 2 months of 2023, many bond sectors are still looking very attractive. But again, there are some sectors where it's looking slightly more expensive right now. So again, that is important to be adopting a very active approach within the bond markets and really looking for the right opportunities. By the same time, if you look across again on the left-hand side, you will see that we have also included what are the yields you're getting right now across the bond sectors. And we find that the current yields in bond markets just generally look very attractive. Even if you're investing in high-quality bonds at the top, so for example, government guaranteed bonds, investment grade bonds, these are giving you anywhere within the range of around 4.5% all the way up to around 7% across different sectors of the bond markets. And at these kind of yield levels, we think that it is looking very attractive because, again, the yield levels give you a very good indication in bond markets of the expected forward-looking returns. When you look back in history, you will see that versus when you look at the level of yields, which is in blue, versus the expected returns, forward returns about 5 years ahead, that's in green line, you will see that the lines actually closely overlap each other. In other words, there is a 94% correlation between your starting yields and your expected forward-looking returns. So right now, I just mentioned that yields across the bond markets anywhere from 4.5% to 7%. That's the kind of expected returns you can get in the next couple of years. So again, pretty good yield levels. And again, if you look at the blue line, which is the current yields we are at right now, you extrapolate that back, you will see that the yield levels that when we last saw levels, yield levels at current levels is actually back in the 2008 period. So again, we have not seen yields at such attractive levels since the past 15 years. So again, very good opportunity to go into bonds right now. Now, I think one of the key questions that we often get is this the right time? You said that the Fed will start cutting, but when, right? Will they start cutting now? Will they start cutting later? Should we wait until the Fed cuts and then we invest? Now, I think this is very important to note because we've actually, again, looked at different scenarios. So we've looked at, first of all, what is priced into markets is that markets are expecting the Fed to start cutting quite soon in March. So that would be, let's say, the green line where we are expecting immediate cuts. There is also, for us at PIMCO, we think that the Fed may start cutting a bit later on, probably towards mid-year or if not second half of the year. So if the Fed actually pauses a while and then starts to cut, they don't cut immediately, that's the blue line. You pause and then you cut. Or there's also a scenario that, let's say the Fed surprises the markets and they don't cut at all, right? No cuts. So that's the red line, higher for longer. But when you extrapolate these three scenarios, immediate cut, pause and cut, or higher for longer, and you compare the performance of bonds versus cash. Bonds is in green. Cash is in gray. You will see that regardless of the outcome, in all three scenarios, bonds actually outperform cash. So again, doesn't really matter when the Fed is going to cut. We know that the Fed is done with the rate hikes. They are going to start cutting at some point. And regardless of when they start cutting, right now, bonds look more attractive than cash alternatives. So that brings me to my conclusion. So if I can recap again, we think that bonds right now look very attractive across a range of scenarios because be it whether the Fed starts to cut or not, bonds will do well versus cash. If we do see an economic slowdown, bonds will actually provide a lot more of that downside buffer and protection versus equities. But at the same time, a quick reminder again, not all bonds are equal. So very important to maintain a very active approach within the bond markets, diversify, to actively look for the right opportunities. So I'm going to stop here and hand it back to Jason. Thank you.
Thank you very much, Alice. Up next, we have Brendan from KraneShares, who will give us an update on the China market outlook. Brendan, please.
Okay. First and foremost, thank you so much for the opportunity to be here. I came in from New York on a very, very long flight. That wasn't a flight, it was a journey, but it's great to be back here in Singapore. I want to talk a little bit about China, but I want to step back and look at what's happening in terms of global equities. And right now, today, since the global financial crisis, the S&P 500 is up 860%. Over the last, so this is 14 years. And in the United States, you'd see that MSCI China is only up 106%. And the common narrative is, well, China's a communist country, it's an authoritarian regime, they kill companies whenever they choose, and we're the United States, we're number one, we made America great, maybe we're about to make it great again. And that explains this huge performance disparity, right? 860 versus 106. The problem with that thesis is that MSCI Emerging Markets Latin America has done just as badly as China. And in fact, MSCI All Country World is only up 237%. Not even 1/3. So is the entire world a bunch of communists that kill companies? So the US stock market is like a black hole pulling money out of everything. That money is coming out of non-US equities across every stock market and going into US stocks. 14 years is 56 quarters of opening your account statement and saying, I diversified away from US stocks and I underperformed. Again, try doing that 56 times in a row. Try being a pension fund where you have to talk to your trustees, your directors, your board saying, we've diversified and we've underperformed. So what do? You slowly start to capitulate. You start selling your non-US, your EM and your China, and it goes into US stocks. So there's a black hole effect. And I'm not saying that US equities are in a bubble. I'm just saying it is the most crowded trade globally. And I've experienced that visiting with our institutional clients all over the world. I always say, what are you overweight? What are you underweight? Everyone is overweight US stocks. Now I think the culprit, the real problem is index construction. That if you looked at MSCI China 10 years ago, 50% of the stocks were in two sectors, financials and energy. And if you throw in industrials, materials, and real estate, these are all slow, no-growth sectors. And the exact same thing was true for MSCI Emerging Markets, 50% in two sectors. So the US market is unique in that it has all of these growth stocks, and no other stock exchange looks like that at all. And now to prove this thesis is, what did a growth sector do? Well, in the case of emerging markets, the technology sector was 10% of the index 10 years ago, 10%. That 10% actually outperformed the S&P 500 over the last 14 years. Anyone want to guess what percentage of MSCI China was in the technology sector 10 years ago? Anyone have just throw a number out there. Take a guess. 5? Divide by 2. 2%. 2% of MSCI China was in tech stocks 10 years ago. That 2% went up 1,500%. So if you found the right piece of China in emerging markets, you ran circles around the US stock market. But you had to go and get it. You had to go and get it. It wasn't given to you. Now this issue of US equity outperformance, I don't know if this is the last iteration, but you have this AI craze happening. And without the AI craze, Ritesh had a great slide showing that equally weighted S&P 500 had a terrible year last year, US small caps. These 7 stocks were the only thing that worked globally. And again, global investors are overweight. And so if you eliminate these names, the US had a terrible market last year. And again, I can't predict that this is the end, but if AI doesn't lead up to the hype, you've got a big problem. And this is true for professional investors, that professional investors, if you're not keeping up with the benchmark, you get fired. And so professional investors, these are the percent of the stocks owned by actively managed mutual funds. And so even professional investors who know they shouldn't are all piling into these names as well. And another factor is the movement from active to passive. That emerging market actively managed funds are going away. They're going out of business. Literally, 20 years ago in the US, 90% of emerging market equity funds were actively managed. And today that's 60%. The amount of money in active emerging market funds is the exact same amount as 10 years ago. They're literally, these managers are just going away. They're going out of business. And what are they doing? I was on a panel at a CFA society with 3 of the largest EM fund managers in the United States. And they said to the first manager, what's your favorite EM China stock? And he said, Microsoft. Whoa. Whoa, really? The second manager, what is your favorite EM stock? And she said, Louis Vuitton. Wow, wow, okay. And the third manager was like, yeah, we own all of those plus NVIDIA. So even these emerging market managers are going out of benchmark to buy the only thing that's working. Only thing that's working globally is US stocks. I mean, and yes, Japan and India regionally are getting some flows, but relative to what's happening in terms of all the money going into the US, and I'm old enough to say I've seen this before, that investors forget that in 2009, US and global investors gave up on US stocks because US stocks from 1999 to 2009 had a negative return. You suffered 2 50% drawdowns and you said, I'm done, I'm out of here. And that is exactly what people are saying for China and emerging markets for non-US equities. They're saying, we're done. And the problem with that thinking is if the next decade doesn't look like the last decade, your portfolio has a big problem. And markets tend to be mean reverting, that just as China stocks and emerging market stocks ran circles around the S&P 500 from 1999 to 2009, the exact opposite has happened recently. So I'm just saying I can't predict the future. You know, I'd be a hedge fund manager charging 2 and 20 or, you know, very high fees. I'm not saying I can do that. I'm just saying if the next decade doesn't look like the last decade, a lot of investors have a big problem. And markets usually do what is not expected. Now, part of what's happening in terms of this outperformance of US equities, it's pulling money out of markets. And that has made markets, particularly China and Hong Kong, very volatile. That there are these contracts that we've been reading about saying that these contracts create forced liquidations. So part of the plunge we're seeing in Chinese stocks is due to these contracts that have principal guarantees in them. And in the absence of buyers, it's creating a lot of downside. And this reminds me of 2015 when the mainland Chinese market, the equity bubble burst, and you had margin calls creating forced selling, which led to more margin calls, and the Chinese government eventually had to step in and say, we're going to intervene. We have to stop this. And that is rumored to be happening right now. That the Chinese government is saying, this is just too embarrassing. You're having these forced liquidations, creating more liquidations, and there's no buyers because all the buyers are in US stocks. There's no one left. And that's created, I think, an interesting situation where a lot of the concerns on China, they haven't necessarily gone away, but they've decreased. And I think there's a lot of doom and gloom. I mean, just being here in Singapore, meeting with investors, you know, they want to talk about AI, US stocks. They don't want to talk about Chinese equities. Even though I would argue a lot of the problems around China have improved or they've gotten less worse. Part of the problem is China is not following the path of the West. That in the West, around COVID, you had free money, just, you know, checks in the mail. And why China is not following the same path is because that's created inflation in the United States. It's the US government now owns $34 trillion. You know, it's created, and so China's saying it's an economic cycle. We're not gonna give away free money. We're gonna let the economy come back slowly, but that's underwhelmed investors. There's a number of opportunities for more policy support to come. Today, the PBOC cut the bank reserve requirement ratio again. Earlier this month, they went to support the real estate sector, which has a lot of issues without question. But they're going to put money to try to stabilize real estate prices, which are weighing on consumer confidence in China. So there is support. It's just been very slow, incremental. Now, the Chinese stocks reflect the end of the world. So these are Chinese internet stocks. This is the price of, if you put them together, but this is their revenues. So how is it that the stocks have come down so dramatically, but COVID didn't put these companies out of business? But investors have treated them like they're going out of business. Certainly the valuation comparison versus US has gotten to a level that's pretty dramatic, but I'm not arguing that's a catalyst. I think the fundamental factors weighing on China are only part of the problem. Some of this is a crisis of confidence in the policymakers, and that's created these valuation disparities. And again, this valuation disparity is driven by everyone overweight US stocks, right? They're selling down all these names to buy these other names. And that's led to a situation where if you take the 31 largest Chinese internet companies, they have so much more cash on their balance sheet than Amazon and, say, Alphabet. And yet, with Amazon's market cap, you can buy all of those 31 companies and have almost $400 billion left over. Amazon, compared to those 31 companies in aggregate, generates less revenue, less free cash flow, less net income, less earnings per share growth. Explain to me why. I mean, almost this is saying Amazon is more important than the potential domestic consumption of 1.4 billion people. I don't think so. But again, this black hole of pulling money out of everything into these names. Apple is no longer growing. Google's laying people off. If those companies don't make earnings, you've got a big, big problem because US stocks are on like a pedestal. And if it gets a little wobbly, it's going to be a big problem. Now, to prove a little bit of my thesis is equity investors tend to be sentiment driven. We read the newspaper, we visually look at things and say, oh, I was in China last month in Hong Kong and Shenzhen, and it looked normal, right? So, buy. But there is an investor like Alice's firm, PIMCO, that breaks out calculators and does the math. Fixed income investors, right? I'm a knuckle-dragging equity investor. I'm like in the Thunderall. But this looks at Alibaba has a bond that trades in the United States. Now, over the last 2 years, interest rates in the US have gone up, which is bad for bonds. Alibaba's bond is beating the stock by 40%. 40%. Bond investors look at the balance sheet of a company like Alibaba and say, can this company pay its coupon and pay the bond back? Unequivocally, the answer is yes. And I could have done this for Tencent and Meituan. And by the way, these companies have virtually no debt. Explain to me how Alibaba is underperforming its bond. Because it's sentiment driven. It's these other factors. The dollar is a problem. If US equities have outperformed non-US equities by 800% or 700%, the dollar is driving the getaway car. The US dollar is up 40% from the 2011 low. Now, that's the US dollar index. If Alice's view is correct, that the Fed starts cutting interest rates, the dollar is likely to roll over, which makes all of that money in US stocks worth less. Time will tell. On the geopolitical, the Biden administration has clearly looked to stabilize the relationship. I don't think the US and China are going to go to the prom together. But I do think there's a recognition, and from meeting US politicians, that US and China are highly intertwined. Now, and think about this. If the US and China have a real problem, explain to me why is Apple stock not down? 16% of the revenue comes out of China. Tesla, 25%. My favorite, when I go down to Texas, ExxonMobil, 12%. So US stocks that are geared to China, no problems. China's economy coming back slowly. I was met with Tencent and BYD last month. They couldn't understand why their stock's down. Companies are doing great. Buying back stock. So here's the asterisk. If we spoke last week and you said, man, that guy Brennan seems like a pretty smart guy, and you bought China, you're down. If we met a month ago and you bought, you're down. Quarter, year. So you have to be, this is my asterisk, this too shall pass. But I do think you have to be very careful. Maybe what we're seeing from the markets, from the Chinese government to stabilize, maybe this is the bottom. I can't say for certain. So my only argument is tread lightly and be careful and work with a great partner like Syfe, right? To help you navigate this. Okay, with that, I'll hand things back to Jason.
All right, thank you very much, Brendan. All right, so for the next segment itself, it will be the panel discussion and the audience Q&A. While I invite the speakers up on stage to join me, may I have the poll results, please? All right, so earlier we asked you guys to fill up a poll made up of 3 short questions. I'll read out the results over here. All right, so first question. No, that is not my question. The poll results, please. All right, yes, thank you very much. So first question, is it still a good time to buy into the US equities in 2024? And 91.3% of you said yes. 8.7% said no. Second question. Brendan's saying something's wrong with the poll. Right, second question, will you increase allocation to bonds in 2024? 38.7 said increase. Okay, we have more coming in. All right, so around 40% said increase, 47% said maintain, and 12% said decrease. 11.8% said decrease. All right. And the third question.
Convincing to do.
Sorry?
I have more convincing to do.
Okay. All right. Third question. Do you think Chinese stocks are a value buy for 2024? All right. I think Brendan was pretty okay. I think results speak for itself. All right. Still 50%. Okay. All right. I'll just leave it at that. Just a quick note. Audience, if you do have questions, please post it up online. We will do the audience Q&A after this. All right, over to you, Ritesh.
Awesome. Thanks, Jason. Some very interesting poll results, yeah. So, okay, let's kickstart this. I'll begin with Giri, right? So, first of all, I guess we had presentations from all of you, and one thing was clear, right? I think Alice mentioned at one point that the US market does look a little bit elevated in terms of the price to earnings ratio and in general the valuations. You saw Brendan talking about it's the most crowded trade ever, with the Magnificent Seven kind of dominating most of the returns for the equity market. So looking forward, what are going to be the driving factors for equity market returns as we head into 2024 and beyond? And more importantly, I think most of us, as you saw there, are heavy into equities, and we would like to continue investing for growth. So what is it in terms of allocation strategy that we should be looking forward for?
Thanks, Ritesh. That is the trillion-dollar question. And after a 25% move last year, obviously we don't expect that necessarily this year again. So there are lots of data points to consider for the United States. And the reason that BlackRock holds that interest rates will cause an economic slowdown, now whether that's a recession or not remains to be seen, but is because that is the historic record, right? The historic record of the Fed is that it doesn't succeed in producing a soft landing. And so the probability is that we will have a slowdown, and after such an aggressive rate hike cycle, that is to be expected. But having said that, I started my presentation talking about some of these structural factors, right, of people leaving the labor market and what that does to wages, what that does to consumption. And it's kind of also hard to see what breaks that dynamic. And so amidst all the data points, yes, you do see incremental signs of stress coming up within various parts of the US. But I saw a statistic 2 days ago, and I've got to go back and check this, but it really stuck in my head, and that is this, that core CPI inflation is running at about 4%, so double the US, the target. But if you take core PC inflation, that's the inflation metric that the Fed prefers. On that metric, if you take the 6-month number and you annualize that, right? So not year-over-year inflation, you take the 6-month number and you annualize that, you get a figure much closer to 2%. And if that's true, then by the middle of the year, if that trend continues, then the Fed is done with its inflation problem, right? And so that gives me a lot of pause to say, well, can this time be different? And if that is true, then we're not having a debate about whether this is going to be a soft landing or a hard landing. This is a debate between a soft landing and a no landing scenario, right? And so the answer to your question, I think, is to remain invested. I think that last year was a great example of people staying on the sidelines, happy to stay in cash, collecting 5%, but then missing out on a 25% equity market rally. So the lesson for last year is remain invested. I'm very happy for people to tilt towards fixed income. As Alice mentioned, there's a lot of value in the fixed income space at the moment. And I think, going all in the US equity market when it's already 40 bips just away from an all-time high, maybe is not so prudent. So maybe tilt towards fixed income, tilt towards some of these structural things that I've mentioned, and tilt portfolios in that way. Try to build some resilience in, but don't exit the market.
Awesome. And that brings to the next question, tilt to the fixed income side of things, right? And Alice, you covered it really well. The fact is that it's the most straightforward trade in the current environment. Like, being in fixed income makes so much sense. But obviously, as we covered earlier as well, a lot of people are invested in cash and they hold a lot of cash holdings. There is so much dry powder in the market. So I guess in terms of transitioning over to higher yielding results and returns for investors, what would be a strategy that people could follow to kind of lean into the bond market? And you, I think, covered a little bit of that as well in terms of, do I wait for the Fed rate cuts to happen now? Do I deploy my money right away? Will be very interesting to know how you think about it.
Thanks, Ritesh. So I think that, as you've pointed out, I mentioned just now that I don't think it's a prudent idea to wait until the Fed actually cuts rates before you start to deploy into the bond markets, simply because markets move in anticipation of the expected Fed rate cut. So you can already see that in the last, the reason why there was such a strong rally in the bond markets in November and December was because the economic data was pointing towards the Fed stopping the rate hike cycle and eventually starting to cut rates. And the Fed was also, so Jay Powell was also communicating that they are done with the rate hikes. So even before the Fed actually cuts rates, the markets have already started to move because they think that the Fed is going to move, so let's start to front run it, right? So the idea is that if you think that the bond markets are starting to, the bond yields are starting to come down, we should move and act sooner rather than later, because right now, as I've shown just now, right now we think that markets have not yet fully priced in the potential for a more pronounced slowdown. Right now, markets have actually still priced in for a perfect soft landing scenario. So that's why right now it's still a good time to deploy into the markets. If you look at even the post the November and December rally, just now I showed you the valuations for across many sectors of the bond markets. It still looks very attractive. But of course, there are some sectors like investment-grade corporate bonds, high-yield corporate bonds. In the corporate space, they look a little bit more expensive, which is why I think that it's important to, again, be an active investor, stay diversified, and so, for example, investing in income plus portfolios with Syfe, I think that could be a really good way to enter the bond markets.
Thanks, Alice. And I think very interesting to note as well, we've seen quite strong inflows into income strategies over the last few months. And again, I think it is important to understand the fact that, cash holding excess of it comes with reinvestment risk, because as the Fed rate cuts will happen, your cash investments holding in excess just in cash instruments will continue to give you, on a rolling basis will yield lower returns. So it's an opportune time to think about elevating your returns, locking in these higher rates as you move forward as well. Moving on, I guess, Brendan, it's a tough one for you. I guess again, all of us want, in some way or form, China to recover. We are all, invested there, but it's been, a very heavy burn, right? And a lot of us, in terms of, being patient, we have been patient for like 3+ years, and it continues to go down. So I think the big question for all of us is, is China gonna be the next Japan? Is it something that has become uninvestable as a market?
Yeah, I don't, I think the issues that face Japan are different, and there are some similarities. Real estate bubble, though Japan was obviously significantly. People will talk about the demographics, but South Korea has the worst demographics of any OECD country, and yet Samsung was one of the best performing stocks over the last 20 years. So I think ultimately it's been a really, really difficult market. It's been painful to watch this market. I've been watching it for 11 years now, but the last 4 have just been absolutely brutal. So this too shall pass. I do believe that. I do think there's this saying that the stock market in the short run is a voting machine, but in the long run it's a weighing machine. And China is not going away. I mean, just being here in Singapore, and you look at all those oil tankers going by, it just shows that that's all going on its way to China, and China's not going away. I think China, there is recognition that there's been some policy errors. That I think President Xi going to the APEC conference and meeting with Biden, that culturally for him to go to Biden, says something, and then his speech at the APEC conference, I recommend people read it, because it was very different. And remember, he didn't have to give that speech to U.S. business executives. He could have gone to San Francisco's Chinatown and spoken to the home crowd, but he chose to speak to business leaders to say, we want you in China. And I think that is an acknowledgement of an error. And there's been signposts of that. Premier Li at Davos, a very similar speech. A week and a half ago, the U.S. ambassador to China spoke at the Council of Foreign Relations, where he said, we just let MasterCard into China. We allowed Broadcom to buy VMware, which no one thought they would allow. They did. And they reinstated the Boeing 737 MAX, which they might want to think about. But you also have, you had this situation a few weeks ago where they, a government official said, well, we were thinking about doing these online gaming spending rules. And the market was like, oh my gosh, here's, so they fired them. Yesterday, they took that draft off. So I think there's a recognition that China needs to improve its corporate image. Capital flow is where it's treated best. And so China, definitely needs to change that narrative. And ultimately, I think that, I call it a crisis of confidence. It'll take a while to return. I mean, it won't happen, but I think there is an effort to affect change in a more positive manner. And this market, I use the term eviscerated, because eviscerated is like a really strong, and that's where investors have come out of this in a very dramatic fashion, and markets are mean reverting. When it's you least expect it, they'll do the unexpected.
Just a quick follow-up on that. I guess like you mentioned the fact that, as the US has become this black hole and people, when they see ex-US not performing that well, and you keep kind of coming back to the US in terms of, and there has been like a preeminence of US in terms of returns. Now, of course, a lot of us also have been invested. So on a going forward basis, people who have already invested in China, I guess like, it's important to also think through how we could position ourselves as we move forward. So maybe a few, pointers on that.
Well, you're looking at an investor who learned the hard way that you need to volatility adjust your positions. That I've lost a lot of personal money investing in China the last 4 years, and that's because I've been very focused on the fundamentals, talking to the company, listening to, and these non-fundamental factors. So I do think that we do have to volatility adjust our positions. We need to take profits. In 2020, at the end of 2019, China had a huge performance. And I was going to sell down my positions because I had made so much. And I said, well, that's not really fair if I'm selling my China shares and I'm trying to tell people to buy them, and I didn't rebalance. And I'll never make that mistake again. That, if you have these outside returns, you should take some profits. And then, if I had done that, then I would have been able to reinvest at a lower level. And I think these are lessons that are hard learned. There's a good book Morgan Housel just wrote that talks about the difficulty in market timing and all these things that that Syfe provides investors. But I think that's a lesson I learned, that when things go up a lot, you should take some profits or take some of the chips off, and that way you have some dry powder to buy low. And that's what's hurt a lot of investors. I think particularly in Asia, is that you're using Alibaba and WeChat, and the stock comes down, and you say, I haven't changed. When I was in Hong Kong and Shenzhen, restaurants were crowded, malls were packed, and you're being, everything's normal, so buy more. It goes down. Okay, we should buy more. It goes down.
No more
buy
money
more.
left to.
And there's a point where you're gone. For many professional investors, they're gone. Bloomberg News had an article about a China's hedge fund that's gone. So you have to be kind of careful. You have to be a little careful.
Cool, awesome. I do want to, kind of transition over after these opening questions. I want to give a chance to all the audience to pose their questions. So please feel free to, take in that QR code. So if you have not yet asked any questions, and after all these insights, if you have some follow-ups, please feel free to keep putting them up. I'm not sure if we can move on to the next screen, but we do have some questions that have already come in. So maybe we take a few of them and focus there. So I think the first few, little bit more macro-oriented. I think everyone wants to know the path to the rate cut, right? So is the Fed cutting rates soon? I think if you look at the markets, if you look at the CME Fed Watch tool, it almost predicts like 5 rate cuts or 6 rate cuts happening this year. Though most of us, I think in the more sane part of the world, would think maybe second half of this year, pause, but then cut, like similar to what you had as kind of the base case, Alice. So I think it'll be interesting to know what your takes are in terms of the Fed path to the cuts going forward, as well as, probably your predictions around recessionary risks as well. So maybe, Alice, you want to start, and then we transition?
Sure, I can start. So I did share earlier in my remarks that our view is that the Fed will probably start cutting around maybe mid-year or potentially even second half of the year. And the reason for that is because I think that was mentioned by Giri in his remarks, that typically the Fed is late to cut. The Fed is late to action. They were late to start hiking rates, and likely they will be late to start cutting rates as well, because the Fed and other central banks, they want to actually see evidence, right? So for example, the Fed was late to start hiking rates because they needed to see that, hey, inflation is really starting to get out of control before they actually do something about it. And then similarly, we think that the Fed we'll need to see actual signs of slowdown before they start cutting. And right now, the economy in the US particularly is still showing a fair amount of resilience. So again, we think that whilst we wouldn't completely roll out a March cut, but we do think that it's more likely that it's probably going to be in the mid of the year, if not slightly later. We also think that, just now we talked about CPI numbers. So it is true that core PCE, which is the measure that the Fed typically looks at, it is actually, even on a year-on-year basis, we expect it to come below 3% within this month. But core CPI is still at 4%. And so optically, it is going to make it very hard for the Fed to start cutting rates anytime soon, because core CPI is still running at double of the Fed targets. And until the core CPI number also comes below 3, optically, we think that the Fed will face a lot of resistance in terms of actually starting cutting rates.
Let me just pick up on that, and it's a really interesting point to segue off, which is to say that, so what's the difference? Why the delta between the core PCE number and the core CPI number? And it turns out the reason is something to do with shelter inflation and the particular ways that it is accounted for in the statistics. And so all of the real-time indicators looking at, Zillow and other kind of online property kind of search portals, all the real-time indicators of what property and rent prices are doing suggest that they've all come down fairly substantially. But that's not surprisingly being reflected in the core CPI data because of the lag and because of the accounting effect. So the question is, when does that accounting effect start to filter through? And whether the Fed is going to take that into consideration if you continue to see this wide discrepancy between the core number and the core CPE, PCE, and core CPI.
Brendan, anything from your side? More particularly, maybe also touching a little bit on recessionary risks in the U.S.
Yeah, I mean, BlackRock and PIMCO are two of the greatest fixed income investors, so I defer. My only observation is the U.S. economy. Cutting interest rates is a very blunt tool, and an element of China's population is in permanent recession. That part of the lower income bracket in the U.S. Has a real problem with food inflation, with gas prices, because those are disproportionate percentages, and other parts of the U.S. economy don't need a rate cut. That they're doing just fine. Right? If you own financial assets, you're up 800%. You don't need a rate cut. So I think that's one of the hard things for the Fed to navigate is this duality. It's a big country geographically. Does Texas need a rate cut or Florida need a rate cut? No, but maybe Michigan and Illinois do. So it's a blunt tool, and so they've got a tough job. But I defer to the experts here.
In an election year as well.
You don't want to get your boss fired.
Awesome. All right, I'll take the REITs question a little bit later, but I think it's interesting on the Bitcoin. So let's, Giri, onto you. And we know that BlackRock came up with the Bitcoin ETF as well. So I think it's a question that's getting a lot of attention. What are your views on Bitcoin ETFs, and do you think investors should include Bitcoin and ETFs as part of their strategic asset allocation?
So this is another area of huge interest for which I have an extremely boring answer, which is that BlackRock has no view on Bitcoin, and I have no view on Bitcoin. Having said that, I will say that we do some internal studies, right, from a portfolio construction perspective, and I thought that it was interesting that if you look on a 1 year, a 3 year, 5 year, and I think a 10-year horizon, that an inclusion of some crypto assets in a portfolio actually improves the Sharpe ratio of that portfolio. So it actually improves your risk-adjusted return. So that's not saying people should do it. That's not saying people shouldn't do it. That's just what the data says over the last 10 years. That may simply be a function of the fact that it was new and there was a lot of early adoption, right? Maybe that's all it is. But fundamentally, what we're talking about, all currencies are, in a sense, individually irrational, but collectively rational, right? There's no reason necessarily to believe in a piece of paper that says a US dollar on it as an individual, But collectively, if everyone believes in it, then it's worth something. And all currencies are like that. So again, that by way of background, but no house view and no view from me.
Anything from you guys?
No view from us either.
All right. Sorry, we won't be able to give a constructive answer onto that, but yes, I guess you can do a more one-on-one with some of the Syfe investment team and the advisory team to get more insights. So yeah, happy to take it one-on-one. All right, moving on. I guess maybe I'll go back to Alice and think about bond investments. And I think you focused and talked about how not all bonds and bond sectors are equal, and there are different opportunities in different bond segments and all as well. And there is this question about which bond investments are good ones to act upon, as well as, I think the next question, how long do we need to stay invested in the bond market for a decent return? So maybe Alice, if you could take that.
Okay, so within bond markets right now, I showed you earlier a chart that shows you the valuation of the different bond sectors versus the 10-year history. And right now, if you look across the different sectors, we would say that from a valuation perspective, corporate bonds look a little bit more fair to expensive. So be it investment grade and even more so high yield bonds. Because last year, high yield had an amazing run. The trade that nobody actually managed to capture. Right? I think nobody was buying high yield bonds last year, but high yield bonds did extremely well. The high yield index was up close mid-teens, right? So, but of course, having had that amazing rally last year, high yield bonds look even more expensive right now. And given the elevated recessionary risk that we are seeing, or rather not recession risk, but more risk of a slowdown, more pronounced slowdown, then all the more we want to stay away from the lower quality parts of the market. We want to stay high up in quality. So that could be some sectors of the investment grade corporate bond markets, specifically focusing on areas that are going to be more economically resilient. For example, some of the sectors that would benefit from a lot of the pent-up demand, like for example, travel, lodging, hospitality, airlines. These are some of the sectors that are still booming, right? A lot of us are now still in that revenge travel mode, right? So these are some sectors within the corporate markets that still have a bit more value. But apart from that, I think where we see more value also is in the securitized or rather asset-backed space, where valuations still look very attractive. They are backed by hard assets, particularly, for example, in the US, where they are backed by housing. The housing market in the US still remains incredibly resilient, given that we see there is still this massive undersupply of homes in the US and still very strong demand. So that supports the home prices. And at the same time, even amidst this current high interest rate environment, most of the homeowners have locked in their mortgages at extremely low rates. So around 90% of homeowners in the US actually managed to refinance their mortgages at very low rates in the past few years, which means that right now we are seeing a lot of resilience in the housing market in the US, and that's also a sector that we find a lot of value in.
Great.
Sorry, one more thing, and then the second question on how long should we hold the bond investments. So I would say that even I think in the nearer term, because we see that right now the Fed is starting to cut, at some point embark on a rate cut cycle. That's when we see potential for bond prices to go up, and right now bond yields are actually out yielding cash, right? So even in the near term, even in the next, call it the next year or so, we think that bonds are going to outperform cash from just a yield perspective. And then in addition to that, because of the potential for rates to start coming down and for bond prices to go up, then we think that investors do not need to be invested for too long in order to see very attractive returns.
Great. Thanks for the perspectives, Alice. Maybe I'll take the REITs question now. So the question is, REITs still a good investment in a higher for longer interest rate environment? And I guess like there is a similar question down as well. Will REITs finally recover in 2024 after a lackluster performance for the majority of the last 2 years? So I guess like, it is important to again understand that the last 2 years is when the interest rates have gone kind of berserk, right? Like the Fed embarked upon one of its fastest rate hiking cycle, and that does impact REITs when it comes to their gearing ratios and the debt servicing ratios. All of those do get impacted. So what you've seen is over the last 2 years, the REITs market remained very lackluster. Even for the last year, for example, if you looked at the REITs market till the first half or even till September, the REITs market remained very subdued, lost close to 10-12% till that point of time. But come September onwards, as soon as we saw that there is a pause in the Fed rate hiking cycle, and there is a prediction that the rate cuts are probably going to happen in the next year, the REITs market actually bounced back quite dramatically, and we saw close to 20% return in just the November-December kind of period, and that is kind of like continued as we move forward. Now, in terms of also, if you look at valuations of especially the Singapore REITs market, the valuations from a price to book ratio is 0.8x, and this is way, way below the historical averages at which S-REITs trade in general. Also, when it look at the yield differential of S-REITs in comparison to the government bond yields in Singapore, there is close to 3.5 to 4% that you are getting on top of what you would get in a government bond kind of a instrument. So you're getting close to 6% yield on S-REITs, and which typically, again, whenever the yields differential goes above 3% or 300 basis points, that's where you see some sort of a bounce back opportunity and a potential for clients to see some sort of rally coming back into the REITs market. So hopefully, if the interest rate path continues, in the anticipation that we have, that even if there is a pause and then cut or a more immediate cut, in both those scenarios, S-REITs should stand to do relatively well. I think most of the S-REITs are also, have been very prudent in terms of just managing their debt levels. The gearing ratio is still sub 40%, which means that overall, the S-REITs market looks fairly robust in this part of the world. And hopefully, again, our wish is that the S-REITs market continue the bounce back that we see or have seen in the last couple of months. So yeah, and feel free again to reach out to us one-on-one as well. We do have a REITs portfolio, and I'm sure a lot of you guys have been invested into it. I think the good news is, again, that dividend yields are pretty good, and I have been using every opportunity whenever the REITs market go down to just keep clipping in DCA and build more, and such that over the longer term you average your investments, and then the dividend yields kind of like remain very sticky. And once the bounce back happens, I think that's going to be a great environment for all of us. Awesome. I guess like moving back to China, I guess let me take this question for Brendan. I guess like the question is, how can Chinese consumption grow in coming years with youth unemployment that is over 20%, while China property sector is in limbo?
Yeah, I mean, on the former, the COVID policy in China, really hit the service sector very, very hard. That, when you get on an airplane, the flight attendants tend to be young people. When you check into a hotel, the person at the hotel is young. Waiters are young. Maitre d's. Delivery people. So zero COVID really weighed on China's youth because of their orientation to these service jobs. And I think it will come back, that number will come back just as consumption trends, as life resumes to normal. And as I observed last month, malls were packed, and these Meituan delivery people were everywhere, and we got run over like 5 times. But I think the youth unemployment issue will solve itself to a big degree. In terms of property is there's 2 facets to the problem. One is distressed real estate developers who over-levered, and when the music stopped, they ran into a big problem. And in the West, a lot of people say this is China's Lehman moment. and meeting one of the heads of one of the largest asset managers in China last month, down in Shenzhen, he said, Brendan, the greatest policy error by any central banker ever was the U.S. Fed allowing Lehman Brothers to go bankrupt, because it created a financial crisis. It got it got the bosses fired. The Republican Party lost the White House. Obama got elected. So why would the Chinese government create a financial crisis by allowing a disorderly default in Evergrande or Country Garden? So I think they take the approach of what the ECB did with Greece, right? If Greece had defaulted in the financial crisis, every German, French, and Italian bank would have gone to zero. So what did the ECB do? They extended the maturity of the debt, they cut the interest rate, and they allowed Greece to muddle through. And actually, it took a long time, but Greece was actually, I think, the best performing stock market last year. So anyway, I think I think that it's receiving a lot of attention. Now, the other problem with real estate is 2/3 of Chinese urban household wealth is invested in real estate. And as those prices came down for the first time in people's lives, Chinese property declined last year. It's never happened. They call it the broken slot machine, right? The machine that just always pays. Last year it didn't pay. In fact, it went down. So that's negatively affects consumer confidence. And they've tried to do this incremental policy support to stabilize property prices. Last week, everything's kind of a blur, but the December sales came out for China. All 70 cities were negative. I mean, there literally wasn't one city, and that's highly problematic for the Chinese government, which means that the sector needs more support, and it behooves them to address this issue. Because if property prices can come back up a little bit, it's going to, imagine the effect that has on balance sheets. Household balance sheets go up, people feel better, consumer confidence. They're probably going to cut. They don't want to cut interest rates too dramatically, because then the currency declines, and the U.S., whenever China's currency declines, the U.S. says, you're a currency manipulator. So they can't cut interest rates dramatically in China until the Fed starts cutting, potentially in March. And what cutting the loan prime rate will do is allow Chinese households to refinance, and that frees up more cash for them to spend. So again, long-winded way. That's a lot of policy support. It's not a problem that will go away overnight, though.
Just to add a little bit on the macro side, I want to echo those comments. But on the macro side, China is undergoing an economic transition. And it actually is kind of similar to the situation in Japan, because Japan also in the 60s, 70s, and 80s had a big infrastructure boom, and then it collapsed, right? And the Japanese have taken 30 years to try to sort out that problem. And they're only doing it now, and I described some of the ways in which they're doing that. The Chinese have a very similar problem, and not to the same extent. The property market hasn't crashed to the same extent as the Japanese property bubble. The Japanese property bubble, the commercial real estate in Japan fell by something like 85% nationwide, top to bottom. That's a huge decline nationwide, not just Tokyo, nationwide. So the Chinese problem is not as significant as that, but it's a variation on a theme, right? So the structural problem that they have is that they've relied a lot on investment and government spending in infrastructure, and that no longer has legs to drive GDP. And so what they need to switch to is a consumption-driven economic model, but it's really hard to do that when all your household balance sheets are underwater and your equity market is tanking, because the negative wealth effect that produces is huge, and it's showing up in all of the data metrics. And so they would have looked at the case study of Japan, and it seems to me that when the US starts to cut, that'll be the opportunity for them to ease further, not just on the property sector, bearing in mind it's 60% of household wealth, but it's also an opportunity for them to shore up the equity market. And I actually think we actually know the solution to a balance sheet recession, right? We've seen it in the United States and a lot of other developed economies. It's quantitative easing, right? That's the answer to this question. Now you can debate how long it takes and whether it's effective in the really long run and what it does, the monetary policy, etc. But the answer to this question is quantitative easing. And I think when the stars align in terms of global monetary policy, I think we could start to see some thoughts of moving in that direction, and I think that will be the catalyst that sends the Chinese market higher.
Awesome. Just staying on you, Giri, let's do it quick one. I think there are a few questions in Japan, the aging economy and the fact that they had trouble revitalizing themselves over the past few decades. And so why is Nikkei suddenly jumping so much, more recently? As well as I think the BOJ and when it will end its negative interest rate policy. So maybe a quick take on that before I move on to Alice to just quickly cover as well, why do we think bonds can give equity market returns, right? Like just a little bit more perspective as to what that means in terms of, equity returns and for bond investments.
Okay, so why now? The first reason is that for about 23 years, Japanese policy was pretty muddled as to what to do about the balance sheet recession they were in. And I say 23 years until Abenomics, which is 2013, where you had the three arrows, targeting monetary stimulus, fiscal stimulus, and the third arrow, which was corporate governance reform. So what were they doing in those 20 years? It was a hodgepodge of, when they were expanding on the fiscal side, they were holding back on the monetary side, and that was in the 1990s. In the 2000s, it was also a mishmash of policies. It never had really a concerted, all sort of guns blazing expansionary policy, which is what was required for the severity of the balance sheet recession that they had. So what you're seeing now is actually that third arrow actually being implemented. Yamaji-san, who is running the Tokyo Stock Exchange, he's made it his priority to actually put pressure on Japanese corporates to return cash to shareholders. And he's producing a name and shame list, and you think about the role that shame has in Japanese culture, in Japanese corporate culture, he's going to name and shame corporate CEOs, corporate companies that trade at price to book less than 1. That's his benchmark, right? So you have this buybacks, and buybacks in Japan last year, in April, the data emerged that buybacks reached a record level. And we expect that to continue with this name and shame list. And so, this is not just to create a bubble in the equity market. This is actually, as I was explaining earlier, this is actually to get cash from the household balance sheet, from corporate balance sheets where it's doing nothing, onto household balance sheets, and then to generate inflation to incentivize households to take risk, to invest, to overcome that inflationary number, and also to spend now because money tomorrow is worth less than money today, right? And so you have all of these elements that are being targeted in a very concerted way, and there's a level of determination there that I think is long-lasting, and a level of ambition that's long-lasting. Final point on negative interest rate policy. It is true to say that the structural drivers of disinflation in Japan are structural, aging population, etc. But that is, I think, a reason for a very gradual exit from negative interest rate policy, because they have just that much to do to support the Japanese household in order to generate that growth.
Sure. So the question on the bonds versus equity returns, right? So I think it all boils down to your entry point, right? Is this the right entry point for equities? Is this the right entry point for bonds, right? And what's the right entry point is when the price is low, because how you make money is you buy low and you sell high. So right now, I mean, if you look at equity markets, they've had a good run last year. S&P 500 is, as Giri pointed out, 40 bips away from all-time highs. So that's not to say that what's high cannot go higher. They can, but typically there's always that potential for mean reversion. So if it's gone up, chances are there might be a bit of pullback, and then if it's very cheap, then chances are there will be a bit of recovery. So we do think that in the shorter term, and if history is any guide or lesson, when the S&P 500 you see PE ratios at 30 or higher, which is the case now, the forward-looking returns is actually closer to 0, because again, mean reversion. Whereas, and so how do you make money in stocks? You buy low, sell high. So right now, is this the best time? Is this the best entry point for broad equities like S&P 500? Question mark. Conversely, in bonds, how you make money in bonds, again, a large part of how you make money in bonds is coupons. So the higher the yield, the higher your coupons and the higher your returns. So right now, again, bond yields on average, which part of the one market you're investing in, that's a pretty good indication of the expected returns on a forward-looking basis. And again, compared to the last 15 years, we've never seen yields at such levels for, again, 15 years. So very good entry point for bonds, maybe less so for equities. I think that kind of sums it up.
Awesome. We are at 7:45, so let's do one last question, more of a closing for each one of you. If you've got 100K right now, what would be your allocation strategy?
The money question. So I talked about industrials earlier. I really like the setup for industrials. We saw industrial orders declining 3 quarters in a row to most of last year. As I say, I think in terms of mega projects, all of that sort of orders are going to come through the rest of this year. So really like the setup for industrials. And then I will say one other sector which I really like, which I didn't touch on earlier. I like biotech at the moment. Healthcare generally sold off pretty significantly last year because of the effect of GLP-1 drugs. Also, if you compare 2023 to 2022, 2022 was the year of all the vaccines, all the revenue coming through, so the comps were really unfavorable. So healthcare did really nothing last year. But I think as a result of the rate hike cycle, you saw that biotech really sold off. And I think as we roll over on rates, I think there's a multiple expansion that remains a distinct possibility in the biotech sector. And I think also you have, a lot of technological advance in areas. You think of oncology drugs, there's lots of advances happening there, Alzheimer's treatments, etc. So I think the technology angle for biotech is a less appreciated part of what's going on. And even things like generative AI, when the number of tokens increases into these models, then you can start, designing new proteins and stuff like that, using some of these foundational models, then I think there's going to be further innovation in that space. So I think there is a multi-year entry point for biotech at the moment.
I'll keep my answer simple. I think you know what I'm going to say. I'm going to invest in bonds. But a high quality and diversified portfolio of bonds. So I wouldn't buy single bonds. I would buy a more diversified portfolio that's high in quality.
Well, I'd rather you made this an actual, if you gave us each $100,000.
Invest with Syfe.
Okay. I mean, just think about what I'm doing with my own money today. In the U.S., I can buy a certificate of deposit for 5.5%. I mean, that's a pretty good deal. If you know the Fed's going to cut rates, you buy bonds, you buy something with duration. So when they cut, you get the benefit. So to me, the U.S. fixed income looks quite appealing. At the same time, the Asia high yield bond market's been just decimated. Because of the Chinese property developers, but they've all been kicked out of the index, or they've gone bankrupt, so that market yields twice. Asia U.S. dollar bond high yield yields is twice as much as U.S. high yield, but you couldn't give shares away. No one will touch it. So I think fixed income is very interesting. Overnight, Jack Ma and Joe Tsai said they're buying Alibaba. So. Yes, some self-serving, talking my own book, so to say. I think China's cheap, but I think India is very interesting. I, agree. Japan is very interesting. That things are not always black and white. It's not, and in the very long run, if you have a very long time horizon, U.S. stocks, even if they crash, in a year or two, if I'm not investing for 20 years, what do I care? If I need that cash, then big problem. But if I don't, just put it away. And so, I think there's a lot of opportunities, in the short run and the long run across a whole host of global asset classes.
Awesome. I know there are a lot of questions still, and we've not been able to take all of them. So we're happy to take them one-on-one post this session. But I guess on a more overarching level, stay invested in equities, but maybe diversify. There are very compelling opportunities in the bond market, so keep a lookout there, move from cash to bonds and beyond. And then on China, stay opportunistic. There are definitely value buys there. With that, we'll turn it back to Jason.
Yes, let's give our round of speakers another round of applause. Right, so with that, I know it's been a very insightful panel discussion, and obviously the audience questions were very, very interesting as well. I'm sure we took a lot of it from this session. Right, if you have further questions, of course, two ways that we can address them. One is, of course, the QR code is still valid till tonight, 2359, I think. You can post the questions up there, right? So we will do a summary of this evening's session, right? And then we'll also answer some of the top questions in our weekly newsletters. So perhaps a side note, if you are not subscribed to our weekly newsletters, you can take this chance to do so. Right, there's also an event survey via the same QR code. So we'll really appreciate it if you could just help us and leave us some of your thoughts as well. Right, and of course, most importantly, if you are an existing Syfe client, right, you can also write into the advisory team. I think Ritesh has also mentioned quite a couple of times. Right, so our email address is advisory@syfe.com, or you could also reach out to your assigned advisors as well. Right, so before I close this event, or rather, before I close this evening session, may I invite Dhruv, our founder and CEO of Syfe, to give us the closing remarks. Dhruv, please.
Thank you, Jason. Thank you to our panelists and speakers today. Your insights and candidness in answering the tough questions is admirable. We're at a cusp of a very interesting point in the global markets. There is good news, often with lingering shadows of the what-ifs. While there is optimism of what can come when the interest rates are cut, what can AI do for the future of the world, there's also fear of war and supply chain constraints and how some economies are coping. Now, we'll all love to have a crystal ball. You know, investing would be much easier. Life would be much easier. That's not the case. With all the information, it eventually sometimes comes down to what we can control. And diversifying your investments, as many of the panelists have spoken today, suited to your own risk-taking ability and your goals is one of those things that we can control. Now, looking back, 2023 was quite a transformative year for Syfe. Alongside our expansion into international markets in Hong Kong and Australia, we also cater to the theme that was very relevant here in Singapore, that being of yield. We started the year with the Income Plus offering and soon moved on to the Cash Plus Guaranteed, which gave both yield and a surety. Now, as you can see on the screen, I think if we can go on the next slide. With the three clear verticals of Syfe, whether you want us to manage your money with managed portfolios, whether you want to do it yourself with brokerage, or whether you just want a safe home for a very low risk to no risk option, there is something which is very holistic that's on the platform. This makes us the only player in the entire region to offer this level of holistic offering. With our new combined pricing, you also get full credit for your faith in Syfe, and something irrespective of which part of your financial journey that you're on. Now, 2024 is going to be another busy year for us. We've been getting a lot of feedback. Some of you are on our user panel, so really appreciate your constant insights. We will be looking to release more products, more features. Also look at genuine use cases of AI, where we intend to give more personalized and customized feedback on your holdings, your portfolios specific to you. We are one of the few multi-billion-dollar AUM managers in the region. And sometimes it feels a long way coming from a humble beginning in an office in Shenton Way in 2019. This has only been possible because of the trust of you, our users. We now manage over 100,000, nearly 5% of Singaporean adults on the platform. And they are here and they trust us with their financial goals. It's interesting to see that last year alone, the average user AUM on Syfe grew by 60%. My sincere thank you for your continued support of our mission to empowering people to build their wealth for a better future. We look forward to this year with the promise of growth, inclusivity, and an innovation in a landscape that is as diverse as dynamic. And we are excited to be building this together with you. Thank you again for your trust in Syfe and joining us today. I look forward to continuing the dialogue. Thank you.
All right, thank you, Dhruv. And once again, let's give a round of applause to the panel speakers as well. Okay, so this concludes this evening's session. So once again, panelists are available outside if you wish to speak with them. Syfe team is also outside to address any queries you might have. Last but not least, I personally do thank the online participants for joining us this evening. Here's wishing everyone a great start to 2024. Thank you.